Hey, what's up, everyone? Welcome back, subscribers, to My World of Stocks, and welcome back to my three stocks on sale series for the month of December 2025, the last month of the year, where in each episode I give you three stocks that I think look very attractive at today's prices for the long term. And although I would normally try to give you guys a little variety here in terms of risk, one low, one medium, and one high risk, well, this month will be a little different because there's actually three stocks in particular that I just really like to talk to you guys about that I think are trading at dirt cheap levels. And all three of them I would actually classify as fairly low risk, maybe medium, low to medium, I'd say. But these are stocks that also have just a ton of turnaround potential at their current levels. And it's going to be including, by the way, one new stock that was actually suggested by one of you guys, one of our best Discord members, actually, who I often agree with, including this time too. So I decided to throw his suggestion into this month's list, which I think makes it for an even funner video. So you're not going to want to miss this. It's going to be a ton of fun. Hit that like button if you're enjoying the series. Let's just go ahead and jump straight into it, my friends. All right, so first up here for stock number one, this month I'm going to be going with, we're going to go with Scotts Miracle-Gro, ticker symbol SMG. Now, Scotts Miracle-Gro, when you look at them, I mean, you want to talk about a beaten down value dividend type of stock with tremendous turnaround potential. You can really look no further. Scotts has always been one of the strongest household brands in the world. I mean, when you walk into a Lowe's or Home Depot, or even just like a Walmart or Target, anything else really, and you go to the landscaping, home and garden care sections, you're going to automatically know that the premium brand there is Scotts. If you want to make sure that you get quality, which I would argue that in that particular field, in that market, customers actually care a little more about quality over price. It's not always the case. It's not going to be everyone. But on average, if you're trying to really grow or maintain something, you're not going to cheap out on these type of materials. And that's where SMG really excels with all of their different products, which, by the way, this is a gigantic market that we're talking about here. I know it may not seem like it, but when you think about every single homeowner in the entire world being a potential customer, let alone all the businesses, residentials, industrials, landscaping and maintenance, parks, public spaces, all of these areas can and often do use products that SMG sells. Now, that doesn't mean that Scotts will actually sell to every single one of those potential customers. That's not really how addressable markets work anyway, right? Like when a company tells you that their total addressable market is worth, I don't know, for example, if they say it's worth like $1 trillion, that doesn't mean they're going to generate $1 trillion in sales, but it just means that they have that gigantic customer base that they can potentially market to, and that pie is worth that much money. It doesn't mean they'll make all the money in that pie, but they can get, a portion of it. And in the case of SMG, I'm just saying that it's gigantic. I mean, we don't really know the limits of it. It'd be pretty hard to estimate. Anyway, SMG has done such a great job that they're number one market share leader, they claim, in home and garden care. Now, you may not personally be into gardening or home improvement, so it might be a little hard to appreciate what kind of demand we're talking about here. But perhaps someone in your household, like your wife or significant other, is more into that stuff. But even casual users who only occasionally need these products, they'll oftentimes just walk into a store like Target and will gravitate towards a Scotts product on the shelf because of how popular and well known the brand is. And they just kind of assume that it's the best and most trusted because of it. And that's really the power of having such a strong brand and solid competitive moat that helps SMG outsell the competition. It's again why they claim to have number one market share. And yet, with so much clear dominance and brand recognition, the stock has actually crashed into the ground more recently, losing close to 80% of its entire value from the top, while even being left negative over the past decade too. Now, if that's not enough to catch your attention, well, the dividend has also soared to one of its highest levels ever at around 4.8%, which is even higher today than it was during the Great Recession. So that should really tell you something about the type of extreme value that we're talking about here. Now, to be fair, I will admit that some of this crashing is actually warranted, especially coming off the pandemic, where, at that time, many people were staying home, had extra disposable income from the government, other sources, and they just kind of spent that money on new home projects and renovations, thus sending SMG's financials soaring to new record highs, and the stock, of course, right along with it. to levels that it really shouldn't have been trading for to begin with. Now, that's number one. Number two is also that the CAN market, which SMG invested very heavily into, turned out to be a bit of a disaster despite showing initial promise. That may still be a future growth catalyst longer term, but in the shorter term, it ended up crashing many CAN adjacent stocks, especially pure plays too, right? And to make matters worse, though, all the sky high inflation and interest rates resulting post pandemic ultimately hurt some of SMG's more premium brands because of people having to opt for cheaper alternatives out of desperation in that scenario. And so as a result, their sales have come crashing, just I would say back down to reality, if anything, which caused their profits to tank too as they adjust to these new headwinds. However, that's where we're left now with all of that damage already, I would say, baked into the price, which now carries tremendous turnaround potential for this market leader that's actually trading cheaper than the competition by up to 30% on a forward P basis. This doesn't make a whole lot of sense considering that the company is actually larger today than it was even pre-pandemic, yet the stock price has been cut essentially in half. So I'll continue being a buyer here at these levels while I still can. It's a stock that I happen to like. All right, guys. For stock number two, though, we're going with a viewer's choice. And it's actually a very interesting one. By the way, like I've told you guys before, the more detailed that you leave your comments, if you actually explain why you like a certain stock, the more likely it is that I will choose it for a future video. And this guy just happened to do a great job. He's really one of my favorite Discord members, always leaving great comments. And here's what he posted this time. So he says, so his name is Shutter Splunker. And he said this about it. He says, Ale, I'd like to see you consider covering Hormel in a future video. So I bought into HRL Hormel. They historically pay a 2.74% dividend. Current yield is 5.11%. They have a 97-year streak on dividends and even increased dividends during the last recession. Payout ratio is at 78%. So they are still safe as defined at Simply Safe dividends. If you go with GLP-1 argument on snacks being a hit, these guys are a good idea since they own and sell Hormel pork meats and Spam, of course, including the largest pepperoni maker, Planters Nuts, Skippy peanut butter, and Jennie-O turkey products. People are trying to eat more protein on GLP-1s. Okay, so first of all, excellent comment, and I agree with pretty much everything you said there. And while I'm not necessarily sure that the GLP-1 craze is much of a needle mover for Hormel, I do think that just in general, we are seeing a rise in protein demand. Prices have been bad for that, and there's many reasons for it, including inflation, livestock shortages, feed costs, tariffs, manufacturing, and more, all making it just a terrible environment for food companies really in general. But when there's fear, you also tend to get some of the best buying opportunities out there, right? And like Splunker pointed out, Hormel, who owns what have been, at least historically speaking, some of the most popular food and snack brands in the world, is probably a good stock to be betting on for that, to be a little greedy on when others are fearful, as the great Warren Buffett would say. In fact, just like I showed you earlier with SMG, Hormel's financials are actually better today than they were pre-pandemic. The sales, for example, are more than $2 billion higher, while gross profit is also slightly higher and a bit more over the past decade too. Yet when you look at the stock price, not only is it down over 50% from the top, but it's also negative over the past decade by close to 40%, which doesn't make a whole lot of sense. Neither does the cheaper valuation than the sector or the roughly 30% discount to their 5-year average. And speaking of averages, this is a dividend stock that most investors used to be more than happy to collect at around half the yield that it pays today, which, like Splunker pointed out there, it now sits above 5%, despite historical averages of only around 2%. By the way, it may not even be the best part of all when looking at that dividend, considering also that this is a dividend king, having not just paid, but actually grown their dividend every single year for about 6 decades in a row, according to Seeking Alpha. Now, granted, the business is going to be very slow moving in the future, and I would only ever really expect a single-digit rise in both sales and profits on positive years at best. But with the price as low as it already is, and with the dividend as high as it is, there's not only rebound potential here in the price, but you'd also get to collect a mouth-watering yield the entire time that you wait, assuming that it doesn't get cut. Now, personally, it's not a stock that I own myself, and the main reason for that, though, is that I just happen to like a little more Tyson Foods as also a rebound dividend value play on the foods and especially meats market. But the more that Hormel falls here, the absolutely more tempted I am getting at jumping into this one too, which I may do very soon. So stay tuned. All right, guys, let's finish up now, though, with the third and final stock of the month. And for this one, I'm sorry, I know I talk about them all the time, but I just can't make a video like this without including what is such an obvious buy to me at the moment here that looks just so freaking good at these levels. And that stock is Vici Properties, ticker symbol VICI, who, in my opinion, is probably the strongest REIT in the entire market right now as an overall package. And I'll keep this short and just make my main point here like this. If you think that REIT stocks are cheap right now, which I would probably call you crazy if you didn't, given all the damage they've taken from our high interest rate environment, but if you agree with me that they're cheap and worth buying right now for the longer term, then how in the world could you not think that Vici is one of the strongest among them? In fact, I'll challenge anyone who doesn't agree by listing off some of their strongest attributes, for which I highly doubt you'll find many other REITs out there, if any, that are better. For example, do you want an incredibly strong and profitable business? Well, you get that with massive casinos and resorts, some of the most popular, that are about as much of a cash cow as you'll ever find. Do you want protection from pandemics and recessions and economic downturns? Well, Vici's collected 100% of their rent every single year, including 2020 during lockdowns. Do you want a growing business? Well, Vici's EBITDA has grown by close to 400% since forming less than a decade ago. And an upcoming lowering rate environment should help boost that even further on new investments and acquisitions. Do you want a high barrier entry against competition? Well, Vici's Properties are some of the biggest, most massive casinos and resorts that are not going to be, let's say they're not going to be easily movable, logistically speaking, almost impossible really to just pack up and move. But they also have to adhere to much stricter regulations because of their gambling nature, which limits their options too. And do you want protection from inflation? Well, many of Vici's contracts are actually CPI linked, meaning they go up right along with inflation. And do you want protection from the huge overhead and operating costs that you'd expect from such massive properties? Well, most of their contracts are also long-term triple net leases, where the tenants are actually the ones responsible for handling most of the expenses. Do you want protection from the retail apocalypse and the rise of online shopping and remote work? Well, Vici's business has almost nothing to do with any of those trends. And do you want all of this for a dirt cheap price that carries rebound potential and a great dividend? Well, not only has the stock been suppressed in recent years because of the high rate environment, but it's even down double digits more recently in the past quarter, leaving it around 22% cheaper than the sector, while also raising the dividend yield up to a monstrous 6.3%, which is among the highest it's ever been. So not only is the business better than just about any other REIT out there, but you're telling me that the stock price is also among the cheapest and the dividend is above 6%. Dude, I'm taking that all day. Vici stock in the 20s, I think that's a steal. But hey, you guys can let me know what you think down below. These are some stocks that I really like right now. And like I said, we included one from a viewer. So I hope you enjoyed that little bit of a mixture there. And let me know if there's any stocks that you guys are out there buying right now. Drop your comments down below. I may include it in a future video. But either way, I hope you're all doing well, my friends, and hope you enjoyed the video. And I will catch you in the next one. All right, take care, everybody. Bye-bye.